Small caps many a times they look good numerically, but how do you go beyond that, because figures can also lie.
For example, 2023 and 24, defense sector was one of the best performing sector of that time. Profit margins improved by 500 to 1000 basis points. But at the end of the day, government of India has a limited budget.
Do you find it that it is research into the small cap space fundamentally a little bit different from the large and mid cap space?
There are close to 600 companies to choose from. Between 4,000 crore and 30,000 crore market cap, it is practically not possible for a person or a team cover all 250 plus 600 stocks, 850 stocks.
What early signs do you look at there is a potential in a company?
We look for scalability of business. Can that business become 5x, 10x?
Hello and welcome to Ventura Spotlight. It is a pleasure to have with us today Mr. Chandraprakash Padiyar, Senior Fund Manager Equity at Tata Mutual Fund. Chandraprakash Padiyar is popularly known as CP and has done his MBA from Symbiosis Institute of Management. CP has more than 24 years of experience in equity research and fund management. At Tata Mutual Fund, he manages the small cap and the large and mid cap fund with assets more than 20,000 crores. So let's get started. Hello, CP.
Thank you so much for having me.
So, this is one of the first questions which we start off normally, what sparked your, the equity journey, and, is this where you always wanted to be? What sparked your interest in the equity markets?
So I started my career in 2000. And I remember in those years in our MBA institutes, consulting used to be the best job profile which everybody used to seek, and similar is for us. In my batch, for example, many people aspired to go to a McKinsey, and McKinsey used to be a good recruiter at that time. So maybe I'll use the word serendipity, which is luck by chance. It so happened that I was in the finance batch, and UTI Mutual Fund at that time came to our institute and recruited a bulk of us. And I was lucky maybe to get into equity research from day one. So it's more luck, and now years have gone by, and it's been a good luck.
So, you have seen, I think, from 2000 till now, it's a nearly 25-year-old journey, and we have seen various market cycles. So, what has been your experience, and what has been your learning on this journey?
So learnings have been quite significant. First of all, when we started in 2000, obviously fresh from colleges, what you learn in colleges and what is the actual on-ground equity research is very different. Practical knowledge is very different. But we were lucky. Again, I would say use this word lucky is that I think in those days, my first organization, our head of research and CIO used to insist on equity research analysts to talk only about long term. So whenever we used to go and meet a management team at that time in 2000, 2004, in that period, we were told that I cannot ask a question for what is going to happen in the next 1 quarter, 2 quarters. You have to ask 5 years and 10-year questions. I think that has helped me think long term, or that's the way we started from a research process. But over the years, competition has increased. Many more mutual funds have got launched. Investors have a lot of option. Our performance is now also judged on short term and long term. So consistency of performance is also important, but you also need to deliver in short term, which means that what has happened over the years, and you will notice this in mutual fund data, is that average churn in mutual fund schemes has consistently gone up across themes, across funds, across segments of the funds. What it means is that there is this short-term orientation that has creeped in. It's an advantage for people like us if you can think long-term and ignore short-term, then it's a very big advantage. This is something that I have learned from experience. But it can also be disadvantage at times, because if you are looking at long-term and market is performing something else, your performance may not look very good in the short term, which sometimes your investors may start asking questions why you are not doing well. So that's another learning, is that market is increasingly turning short term. Its pluses and minuses are both sides. We've chosen our long term path. I've learned the hard way over the last 24 years is that if you be consistent in your thought process, in your investment philosophy, stick to it, disciplined, and think long term. I think the market ultimately gives you a lot of benefits of sticking to disciplined approach. I think that's the biggest learning, that you have to do what you know best and you continue to do the same thing.
So consistency and
Consistent
patience has actually paid over the
and
longer
long term
term.
orientation,
Yeah.
yes.
So since you're also involved with the small cap space, and that is a quite different ball game, little bit. So how is it fundamentally different for you when you're doing research into the small cap space? Do you find it that it is fundamentally a little bit different from the large and mid cap space?
I'll start with a different thought is that definitions of large, mid, and small as a segment of the market changed or got categorized in 2018. The top 100 companies started getting classified as large caps, which in today's market cap is somewhere around 90,000 crore and above is large cap, the top 100 companies. The next 150 companies is mid caps, which is 30,000 crore, approximately 30,000 crore to 90,000 crore market cap. And anything below 30,000 crore is small cap. So first thing is that the industry categorization happened, and I think it's an amazing thing that happened. So clarity came in terms of what is large cap, what is mid cap, what is small cap. The second is, and the reason I'm saying this is that you will observe, and even there are most mutual funds would have, let's say, on an average 20 people in the investment team, anywhere between 10 to 20, 30 people in the investment team. Each analyst, if you do a good job, if you want to do a good job, can maybe cover maximum of 25, 30 stocks on a regular basis. So if you have, let's say, 20 analysts, then you will do 400, 500 maximum stocks on a very well researched, due diligence wise, and know all risk rewards of the company. So in that sense, the universe that a team can cover is maybe 400, maximum 500.
Correct.
You increase your team, you can do more, maybe 550, 600. What it tells you is that the top 100 everybody covers, the next 150 everybody has to cover. So 250 stocks is large cap and mid cap. Then everything is small cap. In small cap, interestingly, in today's market, for example, between 4,000 crore and 30,000 crore market cap, there are close to 600 companies to choose from. Huge universe. And I'm not even taking companies below 4,000 crore. It is practically not possible for a person or a team to cover all 250 plus 600 stocks, 850 stocks. It's not possible. Which means that there is bound to be a lot of businesses which are ignored, which are missed by the market or mispriced by the market. And it is your duty as a fund manager or an investment team, if you want to do a good job in small cap, opportunities are tremendous. At the same time, since they are not covered so well over a period of time, risks are also higher. Because people may or may not know the quality of management teams, corporate governance standards, balance sheet. So all of those things one needs to, when you are doing research, you have to get into. So in that sense, it is different because coverage over the years has lacked. So there are advantages, which is that you get to buy businesses which nobody has even looked at it in a material manner. But on the flip side of it, it is also that these are illiquid stocks because people don't buy them so often. Buy and sell trading activity is lower. But on the other hand, the negative also is that you don't know corporate governance standards of that part of the market. So you have to work harder actually. So that's the difference. Otherwise, research is common. Large cap, mid cap, small cap. What we look for is scalability in a business, quality of management team, cash flow generation, return on capital employed. All of those things I think you look for in small caps also. But the difference is this.
Yeah, because I think generally what happens is large and mid cap space, you also land up getting a lot of research reports available, generally to refer to as a point. But small cap, it will be very difficult for you to keep on getting that many number of research reports itself per se also. Am I right in
True.
saying
No,
that?
you are perfectly right. It's just that we don't rely on outside research at all.
Okay.
Because I have, in my experience of 24 years plus, I have never seen a broker giving me a multi-bagger stock as a research recommendation. If he can give it to me, then he will become a fund manager himself.
But see, yeah, I agree with you that this recategorization, the classification, which got standardized in 2018, was a excellent move by SEBI. Because prior to that, everybody had their own definition of large, mid, and small cap. But do you feel that now, since in the last seven odd years, we have seen the markets having a tremendous run, and the entire the markets have scaled up. That what was actually the definition of a mid cap before, as now sometimes some of those companies are actually gone into small cap, right? I mean, I was just looking at it, just for an example purpose, I'm using it. So Apollo Tires, in 2018 had a market cap of around 18,000 crores, and it was a mid cap stock. And today, with around 32,000 plus crores, it is a small cap stock. So, do you think that there is a need to recalibrate the classification, that large cap should be something more number of stocks, or do you feel that there is a need, or this is a good enough?
I think it it's more about. So I first of all, the honest answer is that I don't think one needs to change this segmentation. I think market is well set, well accepted. What large cap is, what mid cap is, and anything below is small cap. In fact, in our eyes, for example, I didn't mention companies below 4,000 crore for a reason. See, the small caps industry, mutual fund industry alone is more than 3 lakh crore AUM. At that AUM size, the industry will not be able to buy below 4,000 crore. From my perspective, if you want to create a liquid portfolio where there is daily NAV and daily redemption can happen, you cannot be in businesses which are extremely small and very, very liquid. You can have, but very small proportion of your portfolio. So all of us are actually not looking at 2,000 companies to choose from. Our universe is in small cap also is not very large. It's in fact, one of the point that I can say is that what has happened in small cap also is that the larger small caps, which is let's say between 50, I'm generalizing, but not necessarily, but generalizing, 15,000 crore to 30,000 crore market cap, the top 100, 150 companies in the small cap universe, or between 4 and 30,000, that 600 companies universe that I'm talking of, that 150 odd companies would be equally as expensive as mid caps, or maybe higher in some cases. It is so for all of us or fund managers like me to do justice to investors' money today from a risk reward perspective. I'm increasingly going between 5 and 10,000 crore market cap. That's where these are more under research. So I don't think universe needs to change anymore. Even if you let's say change from mid cap from 150 to 200 companies, how does it change things? After a few years, market caps will change because businesses are growing. So we will start saying that 30,000 crore has become 50,000 crore now. Do we still again change? It doesn't make a difference actually.
Do you think that the small cap space is overheated in any manner by any chance?
Some part of small cap, certainly yes. As
But
I was saying,
okay.
Between the larger small caps, which everybody can cover, which are more, let's say, more vocal, who are present everywhere, management teams who are more aggressive in articulating what they are doing and very well. But just to give credit to them, they have done an amazing business. They have grown significantly their businesses. So it's not as if that businesses are good, bad. They are very good. But yes, to some extent, valuations are on the higher side. And for us, but the good thing is that the universe is larger, so you can differentiate. You can go below that particular market cap, and you can find ideas outside of that coverage area.
So how do you see early signs in terms of you feel that there is a potential in a company, and so moving from a potential to a there's a potential, but is it going to perform? So what early signs do you look at for in a company like that?
So I think one is the beauty of being in India is that India is itself growing. So we are our real GDP is let's say growing at 6.5%+ on an annual basis. Even this year it will be 6.5. You have a on an average 4% inflation. So you have a nominal GDP growing at around 10% plus every year. So, and generally we've seen corporate earning grows at either one time GDP or 1.2, 1.3 time nominal GDP, which means that on an average, corporate earnings are likely to grow between 10 to 15% per annum. There are times where you get very bad periods. There are times where you get very good periods. But on an average, you see this kind of earning growth. So we are closer to nominal GDP. So one is growth is plenty. Second is, for example, the reason I mentioned this point is that we all look for scalable business opportunities. So every company is growing. All that we have to focus on is which companies can grow faster or double the rate of nominal GDP. That's our minimum benchmark that we look for.
Okay.
That if a company or a business, can that scalable business grow at 20% plus per annum for the next 3, 4, 5, the longer the better. So scalability, so we look for businesses which can scale, but more importantly, we look for management teams. Our bet is actually on people who are running the business. What they say and what they deliver sometimes can be different, or many times they do differ. So you have to look at the track record of management teams, what they've done in the past, how have they behaved in different cycles of the economy, what kind of capital efficiency does a business have. So many things that you look at. It's not only one thing that matters. It's a mixture of everything. And the most important thing in equity investing is that how open are the entrepreneurs or the management teams to share their wealth with investors. And that comes from capital allocation decisions. So if they are very corporate governance, which is what we say, good corporate governance. So if they are good in corporate governance, then your wealth creation with scale can be very, very high. And over a period of time, markets likes that or re-rates those kind of businesses. So it's not one or two things that I can pinpoint, but a mixture of so many things. But the most important thing, if I have to pinpoint, then it is scalability. We look for scalability of business. Can that business become 5x, 10x from size perspective over a 10-year period, 15-year period? That creates the maximum amount of wealth.
Okay, so I mean, basically, you look at businesses which are growing at 20% plus type. That's what you would actually want to look at.
But the opportunity size should be much larger.
Okay.
So let me give you an example. Let's say today, in terms of market movements, we see a lot of solar module cell manufacturer coming up with new IPOs. A lot of new companies are coming up, and there are existing companies listed on the exchanges. There, I think, when we look at the opportunity size, we think that, and China was an early player there, and China is such a large player in solar cell manufacturing. India is now entering that phase. For the last 3, 4, 5 years, we've succeeded to some extent. And many of our companies are scaling quite well. But our view is that there is significant amount of overcapacity in the world. Now US is building capacities with the way government policies are. In India, we have overcapacity, or we are heading towards overcapacity soon, which means that scalability is going to be a big question mark at some point in time. Which means that today, if the market is willing to give 40, 50 PE to such businesses 1 year, 2 year forward, because of the profitability that these companies are delivering today, may not be sustainable going ahead. So those kind of businesses, so when we are analyzing opportunities, we are always, let me step back, and the first thing that we look for in any opportunity that we are looking at for our portfolios, the first question that we ask our investment team is, what is the risk? How much is my downside? I've learned one thing in the last 24 years, that if you can protect downsides, upsides automatically come. So one thing I have to, or we focus on, is that the scalability is there, or even if it is, how much is it in the price? What is it that the market expects from that opportunity? And what is it that we believe the business can deliver over a period of time? If there is a mismatch, if there is a gap, then we say that there is mispricing, and we can maybe take advantage of that mispricing. Because it is not as if that we are the only guys in this market researching on that particular business. There are a whole host of people researching, good people, smart people doing everything. So the only thing is, your patience, your time, your conviction in a business, and your ability to be early in identifying a trend and betting on the right people who are running the business. So it's many things come. So I think interestingly today, I can give you one thought is that when I meet businesses these days, very positive thing that I see is unlike the past, and from my 24 years experience, I'm giving a relative differences that I've seen. Is that in the past, whenever I used to visit let's say a plant of a business, manufacturing company, generally, you visit a factory of a company, you come back and then review that it's a good business, they are doing good manufacturing. But in the last 2 3 years, one thing very odd or a good thing that has happened to us is that we have or management teams have started telling us that you are visiting our factory very good, but can you also go and visit our R&D center? Uh, what it means is, and we are seeing good signs. We are seeing some companies working on cutting edge R&D also. Not many, but these are early days. And some of them we think next year could be launching their products, first time ever in the world. Some Indian companies will have first time products being launched for the world. So we are seeing those kind of opportunities also in the market. So it's a mixed bag. There are some businesses which may not scale. Some businesses we think are very early signs of R&D driven scale up that will happen. So that's what we see.
Hey, nice to hear these perspectives. And so, one is we always measure, we have return on capital employed as one of the metrics, how important it is in your scheme of things, and, what other parameters do you look at?
So it is an important. In fact, in our investment philosophy, our philosophy first of all is growth at reasonable price. And growth at reasonable price basically means that we are looking at growth companies available at a reasonable valuation, which means that in our investment horizon there is room for valuation re-rating. So we are early investors. That's what it means, that we buy businesses at a time when there is mispricing, where market is not or have ignored positives of that fundamentals. And over a period of time, as and when that company delivers, you see re-rating of valuations. But one thing that is tying up all of this, which is growth at reasonable price, is return on capital employed. We would ideally want to have businesses in our portfolio which generate ROCE more than cost of capital, which means that they are free cash generating, which basically means that most of those companies will be able to fund their growth on their own cash flows. They will not need to raise capital from the market, or they will not be dependent on the market to fund their growth. Because in bad times, if nobody gives you capital, then you can't grow. If you can't grow, then you don't get enough valuations, or you get de-rating actually. So ROCE is a very important parameter for us. More than that, as a parameter, it is the free cash generation. So if you look at, let's say, my portfolios, Tata Small Cap Fund, since we are referring to that, you will observe that 90% plus companies, barring financials, because they are on leverage only, but 90% plus of companies that I own have zero debt on the balance sheet. In fact, have net cash on their balance sheet. And whoever has debt have done some large capex or some large M&A, and hence there is some leverage that has come by. But cash flows are so strong that they will pay off that debt very soon in the next couple of years. So we are focused a lot on free cash generating companies, and I think that, and I will give you from my own experiences. I have learned the hard way that, especially in small caps, this happens more so in small caps, but even has happened in large caps and mid caps, but more so in small caps, is that whenever you have a balance sheet which has high leverage, and the company is not generating free cash, which means that return on capital employed is less than cost of capital, and if you have an economic downturn and in that period, the management teams start cutting corners. The honesty level goes down. From a transparency perspective, from dealing with investors, stakeholders, they start delaying money to their creditors as well. So many bad things start happening, and it is from experience we've learned that cash flow is important. For example, I remember between 2006 to 2008, the kind of market that we were in, and I was young at that time. I had just started. That was my first time I had become a fund manager. And obviously everybody learns from experience.
Right.
And if you go back to that period, uh, government of the day was incentivizing private enterprises to enter telecom, BOT roads, power plants. In fact, power plants used to be ultra mega power plant used to be the craze at that time. Reliance Power IPO happened at that time, if you remember. Uh, so, and which means that that time cyclical businesses were aggressively growing, and they all grew on the back of taking loans from banks. And from experience, we know this is that ultimately they all bid at aggressive levels, and when we saw economic downturn, the assumptions went down, and most of those businesses went into NPAs. And shareholders, investors lost a lot of their capital, and even today, those stock prices have not gone up. So it was permanent loss of capital. That's something that we would want to avoid, I think, and that's a very big learning.
Yeah, I think that's very important that investors should not have a permanent loss of capital. I think that's very challenging. Now, supposing if so, I'm just trying to put it into more of an example. If cost of capital is 10%, and what would you expect a reasonably good ROCE on that?
So it's also a function of growth. So sometimes if a business can grow at 25% per annum, and even if because they are reinvesting aggressively in their business to support that growth, for a few years, if your return on capital employed is barely above cost of capital, though you are generating capital enough, so let's say you are 12-13% and you're growing at 25%, it is not a very bad thing to have.
It's a good indicator.
It's not a bad indicator. It may not be extremely good, but it's not a bad indicator. Provided we believe in the business that, as and when you stop investing aggressively, the inherent return on capital employed is very high. So it's more important to not. So, in other words, what I'm also trying to say is that just looking at the current numbers may not help you to decide very well. You have to dig deeper and see what is the inherent return on capital employed. And which is why I always say that investing is not only science. Sometimes it is also art, or many times it is only art. So you have to look at your experience, what people. So again, the same thing. You have to bet on the people who are running the business.
Correct. Okay. So we always find that small caps many a times they look good numerically on paper. I mean the figures and everything are good, but how do you go beyond that? Because sometimes figures can also lie. So,
Many times. So yeah, you are right. Especially in bull markets, because when stock prices are going higher, people tend to do lesser research, because what happens is that you don't have time. Your reaction time needs to go down. Decision making needs to be quick, because let's say I've met a management team today, and in a bull market, typically what happens is that the stock price is going up almost every month. Like it used to happen in 2023 and 24 calendar years, if you remember.
Yeah.
And at that time, your decision making time needs to be very quick, which is why we always say that fund managers need to have experience. What happens is that in good or bad times, we know what management teams have done in the past, how have they reacted. So your decision making time is not so big, and you can decide quickly. But it does create problems, in the sense that if you have a roaring bull market like what we had in 2023 and 24, there are chances of people focusing only on short-term numbers and forgetting about long-term potential. Let me give you an example. For example, defense. 2023 and 24, defense sector was one of the best performing sector of that time. And what everybody did was, and just to put things in perspective, in those 2 years, almost every defense company improved profit margins by 500 to 1000 basis points. Huge profit margin improvement. But the thing is that prior to that period, the base was extremely low. So it so happened that, and the government of India also started focusing on defense spending, and they also started incentivizing, and these are all largely PSU companies. So they started giving large orders, unlike the past, and execution pace picked up. So operating leverage came in, and your base was also low. So for a few years, like till last year, for example, FY25, most defense companies have delivered very high profit growth, and they are sitting on all-time high operating margins. Most companies are 25, closer to 25, or some are higher than 25% also. Now, the reason I am giving you this example is that if you only look at numbers, it looks as if that they're generating 25, 30, 40% return on capital employed. These businesses are growing very fast, so it's a blind buy. But when you dig deeper, what we see is that yes, these are good companies. They have done very well. They have a very large order book. But at the end of the day, Government of India has a limited budget. They allocate some budget in the annual budget, and they have committed amount capital spending over a period of time. Also, what we see is the government is saying that they want to incentivize private sector to enter defense in a larger manner. And that process started 10 years back, or more than 10 years back, but it has picked up tremendous pace now. We are finally seeing platforms being built by private companies, which was never the case earlier. So incrementally, I would say, and that's the government objective, that they want to incentivize private sector to get more market share in the next 3-4 years or next 5 years. Which also means that competition is increasing for the existing set of defense companies in favor of the other more agile private sector companies, is what I would say. And which also means that the current margins may not sustain. And even if sustain, incrementally cannot go higher. They are already very high. Your base effect will start playing adversely. What was favorable may not be as favorable incrementally, which means that if you are paying high valuations to such businesses, one needs to be thinking 10 times.
Correct.
I am not saying they are bad companies. I am actually saying they are very good companies. They have very good order backlog. But the kind of earning growth that they've delivered in the last 3-4 years are certainly not sustainable. Incrementally, it will probably be very close to low double digits, maybe CAGR. In that case, your P valuation that you're giving is very high. So you ask a very valid question, or right question, is that sometimes numbers give you a very different perspective. You need to look forward also.
Right, because we are investing for returns to be in the future.
Yes.
So it has to be more forward looking, and the numbers are actually more backward looking.
Yes.
In that sense. Okay. So any experience you can share, in this, you had a 24-year stint which is there, which has been something which has been good, and something which has been more like a learning experience that you wish you would not have done that. Anything what you can share?
Yeah, plenty of them. But from a general perspective, I can say is that, which I did say earlier, which is that from experience, I have learned that leverage kills you as an investor. So we totally avoid businesses who have high leverage on their balance sheet. And the other thing that I have also learned, and I'm implementing this as we speak, is that, and this applies to financials, because financials is a large part of our market, banks, NBFCs, all of those things. And over the years, I have realized that you have to dig deeper in financials a lot. You cannot rely only on what the management team has told the market. I've been guilty of doing that in the past. You have to keep doing channel checks. So, for example, let me give you one thing that makes me a bit cautious in today's market, for example. Though I like financial, by the way, in my portfolios, in large and mid, I run 2 portfolios, one Tata large and mid cap fund, one Tata small cap fund. And in the Tata large and mid cap fund, I'm quite overweight financials today, banks especially, private banks to be specific. Whereas in small cap, I have lesser financials. I have very few. So I am optimistic. But having said this, in the last 3-4 years, the banking sector has grown on the SME, MSME lending by 35-40%, many banks. Uh, every time I've seen this, it does lead to some mishaps going ahead. Because what happens is that over leveraging happens in the system. And when you do channel checks, you do realize that some amount of uh, uh, over leveraging may be happening as we speak. I'm putting this word maybe because you are never sure. Uh, but it does make sense to be cautious on that side. So when we pick and choose banks out in the industry, we are more focusing on banks who are doing a good job in risk management
Okay.
and who are preparing themselves that if something goes wrong, they are already prepared. So you have to. So experience has taught me that whenever things are growing too good, you have to start looking for negatives, which is what I am doing in the financial exposure, for example, as we speak.
Okay. Good, good. I think that's very important. Huh? So, one last question. How do you unwind yourself at the end of the day? I mean, the markets make you dizzy. So, how do you unwind yourself at the end of the day?
No, in that sense, our job is 24 by 7. You cannot uh, uh, take your mind off. There are so many things happening every day nowadays, especially in current times.
Correct.
You have President Trump tweeting
Right.
almost every day now, and it has implications for everybody. So, for example, I used to, earlier, I never used to look at my mobile phone first thing in the morning when I used to get up. Now I Twitter is a habit now. Now X. It's the first thing that I do is now look at for 15-20 minutes. I'm looking at who tweeted what in the night. So it's changed. But having said this, I'm more a family person.
Okay.
I have a young, very small daughter, 9 years old now. But it's a joy to play with my daughter. So it's more unwinding with the family and.
Okay, that's good. So we will just run a rapid fire. This is what we do. So just some. So what gives you more anxiety? Market volatility or Mumbai traffic?
Mumbai traffic any day.
I'm sure everybody faces
Yes.
that. A one-line pitch to Warren Buffett to make him invest in India. What would you say to him?
Scalable opportunity.
Which investment theory sounds good in books but does not work in real life?
Investment theory sounding good in books. I think efficient market hypothesis is what I have learned or I have read
Ah,
in or during my MBA days.
and markets are never efficient.
At least that's what we see every day.
Right,
So there are opportunities everywhere.
correct. What do you trust more, the monsoon forecast or mid-cap guidance by companies?
No, you can't rely on both.
Both. If your fund was a movie, what would you name it as?
So from an investor perspective, it would be Zindagi Na Milegi Dobara.
Right.
But from my perspective, it will be Lambi Race Ka Ghoda.
Arey wah. So thank you, CP. It was a pleasure, having you and conversing with you. Thank you very
Pleasure.
much.
Thank you so much.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully